What is going on, everyone? Welcome back to the channel. It's been a little while since I made a video. Had a lot going on in my personal life, but I'm happy to be back, and we're going to start making videos once a week again. So be prepared for that. Now, in this video, I want to talk about ICT and volume profile. I want to talk about how I marry these two concepts, which are really not used by a lot of people in conjunction with each other. I think it's something that is quite unique to my style of trading and kind of the way that I've formulated a trading system. I think they marry each other very well. I really think this combination is slept on. So what I'm going to do, I'm not going to make this all fancy and beat around the bush. I'm just going to mark up a chart from today. So May 20th, 2025. We're going to go over today's price action on the ES, analyze it using ICT and volume profile. We're going to show how I use these two concepts to get directional bias and entry and exits. And I'm going to go step by step. And I took these trades. So I took shorts today. That was my bias using these concepts. And yeah, let's just get right into the charts. I don't want to waste too much time. This video is not going to be edited super fancy today. I just want to get into this and just really get to the meat and potatoes here. So let's actually start this chart completely naked. We're going to go from the very beginning. Now, the first thing I do every single day is I mark my volume profile levels. So there's a few different ways to use a volume profile, right? And there's no right or wrong, but the way that I use them is specifically looking at the previous day's value areas. So that would be the previous day's value area high, the value area low, and the point of control. The point of control being the most important level on my chart every single day, even more important than some higher time frame fair value gap or some type of, something that has to do with ICT. The previous day's point of control is my line in the sand 9 out of 10 times for directional bias. And I'm going to get into that. But let's just show you guys how I get the levels on my chart. You're obviously going to need to know how to do that. So we're going to be using the indicator session volume profile. Plot that on our chart. Now, first thing you need to know is when you're plotting these levels on your chart, you need to use the 30-minute time frame. Market profile and volume profile were created under the assumption that you will be using the 30-minute time frame. Now, I could do a whole video on why that is. Right now, I don't think it's relevant. I just want to get into the technicals here. But please understand that you're going to get the most accurate levels, at least when you're trading it the way I trade it, by plotting these levels off the 30-minute time frame, because the levels can vary a little bit depending on what time frame you're looking at. So stick to the 30-minute time frame, and these are going to be my key levels every single day. Now, this is the current day's profile, right? So this is Tuesday's action. We're not looking at Tuesday's volume profile. We are looking at the previous days. Why is that? Well, this profile, it's after market hours now. It's 6:30. So this profile is now complete. But if I am trading during the New York session, this profile is not finished developing yet. Now, there are people who use the developing profile for their own system and strategy. That's not the way we do it. I like to use the previous day's levels because they are static. The point of control stays where it is. Value area high stays where it is. Value area low stays where it is. So we are going to plot the previous day's point of control, which is right here, this red line. The red line is the point of control. Now, you probably already know what this is, but just for people that are new, previous day's point of control is the level on the chart from the previous day that had the most volume conducted there. So the most transactions and orders happened on this level right here at 5974.75. So I plot that level on my chart, previous day's point of control. You can already see right now how relevant the level is for the next trading day. But on top of that, we're going to plot the previous day's value area low. Now that would be right here. Now this histogram is your value area. So if you see where this is highlighted, this is where the most volume was conducted for the entire trading day. Down here is lower volume areas because it's not highlighted on the chart. That's the overly broad, simplified way of looking at a volume profile. So we're going to mark previous day's value area low right there, coming in at 59.37. Now, for the point of control, because it's really important, I like to use a hard red line. For the value area high and low, they are very important levels, don't get me wrong, but I personally don't like my chart to get too cluttered and feel messy. So you'll see this line is a bit hard to notice, but that's just the way I do it. That's just my style, but it is right there. You can see where that dotted line is. Now, the value area high of the previous day, it's not going to be very relevant for this particular example because as you can see, the profile kind of stops being highlighted at the very top. So in this case, we don't really need to pay attention to the value area high. Now, just so you can see a different example, if we look at the current day's profile, the value area high would be right here, coming in at 59.70 because that's where the highlighting on the histogram stops. But in this case, we just don't really have a value area high, so I just don't need to plot it on my chart, right? Now, the other two levels that I'm always marking off, which is probably something that you guys are already used to, is previous day's high and previous day's low. So we'll mark that off as well. Previous day's high, previous day's low. Now, we have our volume profile levels on the chart. So now I like to make a little folder right here. I'll name it previous day's volume. And then I just put all these in the folder so I could get to them really quickly. If I need to minimize them real quick, get rid of them, bring them back. I could just do it really easily with that folder. Now we can get rid of this indicator. So we don't need to be looking at the volume profile throughout the entire trading session. Again, there's other people that do. It depends on how you use it. I'm going over the way I use it. I just need to mark those levels and then I can get rid of this. Now, if we look at this point of control, market opened right here at 1800, right? We have a sweep of previous day's high. Then we have a retracement or a displacement move down, breaking structure. How do I classify a break of structure? This is where we're going to get into more price action, ICT related concepts. We took out the last higher low that made a higher high. Once we take that out, we swept previous day's high and then we took out that low. This is a relevant higher low and a valid market structure shift because it was taken out, and the higher low that made a higher high is the level that was taken out. That is a valid market structure shift. Okay, a lot of people get confused on what a market structure shift looks like. They'll look at any little move like this on the chart. They'll see like markets going up, markets going up, markets going up. Then we start consolidating. And then you start getting like something like this. And they'll classify this right here as a market structure shift. Right here. But it's not a valid market structure shift. Why is that? Because the last higher low that made a higher high has not been taken out. This is substructure, or you could even just chalk it up to consolidation. Now, this depends on what time frame you're looking at, obviously, because this could be a valid market structure shift on a 1 minute time frame or a 15-second, whatever you're looking at. But it depends what time frame you're looking at, right? But this is not a market structure shift. What would make this a market structure shift is if this level gets taken out because it's the last higher low that made a higher high. That's a quick understanding of market structure. So we get the market structure shift after sweeping liquidity, previous day's high, and then we continue to consolidate. Now, coming into the New York session, there's a couple of things that I paid attention to that made me have a very strong bearish bias. Now, today was not a very easy day to trade, all things considered. It was incredibly choppy, but the draw on liquidity was still clear, and we were able to execute and analyze off the correct draw on liquidity. To do this, I go to the higher time frame. So let me clean up this chart and just kind of analyze the higher time frame on what I was thinking. This is where ICT concepts are going to come in. Obviously, we are in a 4-hour uptrend, very strong 4-hour uptrend, right? Now, this is coming off the heels of a pretty strong daily downtrend, though. But we did break structure on the 4-hour time frame right here, like a really higher time frame structure, because we took out this swing low that made this lower low, and it's finally been taken out. So higher time frame, we are definitely bullish, and I'm not changing that that bias. But again, we're day traders, right? So I'm more focusing on the internal structure here, and then I'm going down to the 5, the 1 minute, the 15 minute to kind of get my entries and exits. So what I wanted to see was for the market to rebalance this 4-hour fair value gap right here. Now it happens. And I talked about this on my Twitter. I made a post saying I want to see the 4-hour fair value gap on ES and NQ get rebalanced. So this is not hindsight trading, and I did take these trades. I took shorts down into the 4-hour fair value gap as my draw on liquidity. So that's our draw. Why is it my draw? Because number one, we've had a really strong uptrend. The market can't just go vertically up forever. Number two, we swept liquidity right here, higher time frame liquidity. And what I liked about it is that we could not get displacement above this swing high. Okay, it would be a different situation, possibly, if we got strong 4-hour candle closures above this swing high, but we didn't. We kind of swing failure patterned it. We kind of tapped above, but really we just wicked above, closed back beneath. So where do my eyes go to when that happens? I'm seeing this as a liquidity sweep, and I want to see us rebalance and imbalance, which is right here, this 4-hour fair value gap. So that was the draw on liquidity. Now let's go back down to the lower time frames. Number two, what do we have right here? When we made this low, we created a 1-hour fair value gap right there. This was going to be my line in the sand from an hourly time frame perspective, but what else? We also had a 1-hour market structure shift right here. This is the last higher low that made a higher high, and we took it out. 1-hour market structure shift right here. So this is what I want to see to really begin to believe that the hourly trend is beginning to shift, which can allow me to bring my eyes towards the imbalance that I want to target. So what happens once we do that? We make the lower low, we put in our lower high, and this is what we were trading, this lower low into the imbalance. Let's get our volume profile back up. Now, really easy rule of thumb when using volume profile, especially for beginners. This will, I swear to God, this will keep you on the right side of the market. If I'm being realistic and not trying to be a guru about it, 8 out of 10 times. That's how accurate it is. 8 out of 10 times you will be on the right side of the market if you follow this one simple rule, which is if we are below the previous day's point of control, short. If we are above the previous day's point of control, long. Now, do I follow that 100% of the time? Absolutely not. But I've been trading with volume profile for 3 years now. I've been trading 4 years, and it wasn't even a full year when I started using volume profile. I started using it even before I started trading ICT. So I'm really, really familiar with these levels, and I can tell you with confidence that that simple rule of thumb will keep you on the right side of the market way more than you would be wrong using that rule. So if you're new to it, I highly recommend try and put that in your arsenal, especially if you're somebody that likes hard rules like that to keep you out of trouble and, kind of save you from yourself. Telling you, use that rule. It'll help you so much. But anyway, what do? We are understanding that if we're below the previous day's point of control, we want to stick to a short bias. We know that we got a sweep of liquidity and then a valid market structure shift. So now that is our key to want to look for this to become a lower high into a lower low to, again, rebalance the 4-hour fair value gap, which was our draw on liquidity. Now, what are the last few things that we need to accomplish to really get a high probability entry signal? Number one, SMT divergence, and then we want an inversion fair value gap. This is where we're going to use NQ and ES to identify the SMT divergence. If you don't know what an SMT divergence is, I'll link one of my SMT divergence videos, but for a very quick explanation, it is a simple price action divergence between a correlating asset. So in this case, if you're trading the ES or the NQ, which is what most futures traders are using, you're going to use the NQ and the ES as your SMT divergence confirmation because they're correlating assets. Now, 9 out of 10 times, let's just do this real quick on the chart. Let's get rid of this. So we have a clean chart to work with. 9 out of 10 times, what's going to happen with the NQ and the ES? They're going to move in tandem with each other. Let's say this is the ES, making higher highs, higher lows, higher highs, right? This is the ES. Now let's say NQ is doing something like this, starting to make higher highs, higher high, higher high, and then it makes a lower high and a lower low. But NQ made a higher high here. This would be a divergence in price between two correlating assets. ES makes a higher high while NQ made a lower high. Now, let me just show you with the price action. It's probably a little easier to understand. Let's get the chart back up. Let's focus right here. So this is Tuesday's candle at 1:30 a.m. during the London session. If we go from here to here, ES made a higher high, right? Just briefly, it swept to this high, tapped into the previous day's point of control, tapped into that 1 hour fair value gap, and then started breaking down, right? Let's go to NQ. Remember, this is the candle we're going to be pulling the SMT from, 1:30 a.m. Tuesday. Let's go to the NQ. (1:30 a.m. on Tuesday. NQ did not take out that high right here. Now, are these kind of equal highs? Yeah, just about. They're not perfect equal highs. It's technically like a tick lower, so it is a lower high, but that's an SMT divergence. So a more perfect example may be if it was like a perfect lower high like this, but this is valid, okay? It's not correlated at the moment. ES swept this 130 high. NQ did not. That is your SMT divergence. That is the reversal price action signal. So let's go back to ES. So we have that SMT divergence. What's the last thing we need? First off, let's go over what we have. Higher time frame alignment. We swept a 4-hour swing high and we had a market structure shift, right? Market structure shift being right here. Once we get that market structure shift, we want something to target, right? We have that 4-hour fair value gap. Very wide open price, wide open imbalance that we could say the market should tap into if it wants to rebalance price. This is how the market was, before this happens, just a wide open imbalance. Now, let's go back to the 15-minute. Let me go back here. There we go. SMT divergence, market structure shift. SMT divergence up at the highs, previous day's point of control also being our line in the sand for shorts. Again, simple rule of thumb. If we are below previous day's point of control, short. If we are above previous day's point of control, long. But on top of that, we have all of this other confluence stacked together. We have the directional bias, we have the market structure shift, we have a higher time frame liquidity sweep. We have everything. We have truly everything we need. This was an A+ setup, which is why I was in it, even through all this chop. I sat through this trade because I just felt so confident that this is where we were going. I mean, it just was very clear. Now, the market made it really tough to try and stay in that trade. But if you had conviction in the directional bias, you made money trading this system. And we did. Now, but what is the last thing we need as our entry signal? We need an inversion. What's a valid inversion to take? Well, this is a 15-minute fair value gap, right? And it's the last 15-minute fair value gap that created this SMT divergence. Now, it doesn't have to always be like that, but it just makes it even more relevant because it's the last bullish level that created the SMT divergence, kicked it off, and then we inversed it and started going lower. So what happens here? 9 a.m. Now, I was in this trade at like 9:20. So right here in this candle, stops just above the SMT divergence. Why do my stops go here? Number one, it's just recent structure. It makes sense. It also makes sense to keep it right above the previous day's point of control because once again, if we're going to be right on the directional bias and the draw on liquidity, and we've already engaged the previous day's point of control, not once, but twice, and then we got our entry signal and everything, it's just a really, really coherent place to put your stop because if it does go above here, the SMT divergence is now invalidated and it means you might be wrong on the trade idea. And then we're targeting the 4-hour fair value gap because that's the draw on liquidity. Now, it took a while. I mean, this was not an easy trade to hold through, but it was just one of those things where I just sat in the trade comfortably. And what I started doing was when we got that inversion, once we get the inversion, I really don't want to see us get back above the inversion. So as we start breaking down here and here, this is something I like to do. I like to reduce my risk. Now, some people don't like doing that. They want to keep their stop exactly where it is and they don't want to get wicked out early, blah, blah, blah. That's fine. That's not the way I like to do it. I like to reduce risk because I'm going with a higher R multiple. I'm okay with taking some paper cuts, some break evens, some reduced losses because my wins always greatly, they just greatly outrun my losses by a significant margin. So as we got that inversion and then we started breaking down, I am comfortably moving my stops right above this wick. So now I start doing that. What does that do? It turns my trade into a higher R multiple. Now, my original risk was right here, about 38 ticks. But once I get the confirmation I need, if I'm on the right side of the market, then price is going to tell me so. And I should be able to comfortably reduce risk as price goes in my favor. Because as things start working out the way I'm intending, then we should start these highs should become protected. So that's what I do. Again, you don't have to. You can just keep your stop right there. You don't want to get wicked out. It's something that might cause you to tilt. I totally understand. This is just my system. I'm okay with doing that. So I move my stop just a tick above the last structure high and the inversion fair value gap. And then it's just a matter of sitting in the trade, right? I'm not someone that takes partials. I like to get one in, one out. If anything, I might trail my stop depending on the situation, but I don't even like doing that. I like looking for my target and either getting a break even or getting full target because I need those R multiples to be significantly higher than my losses. That's just the way I trade. But as you can see, we chop around for quite a while. Once we break down, I reduce the stop, and then we get this beautiful 15-minute candle that just goes straight down and delivers price to our draw on liquidity. Now, why am I targeting right here at the beginning of the gap and not the midpoint or all the way at the bottom? Well, at the end of the day, the 4-hour fair value gap is a bullish level, right? It could become support. It's something that, especially in this context, because we're in a higher time frame uptrend, this could be all the market wants to go to and then continue higher up to the high of the range for all I know. So it's just safer for me to place my take profit level right at the beginning of the fair value gap because, I mean, in this case, we actually did rebalance the majority of the gap. I'd say a more aggressive TP would be at the midpoint because oftentimes we will at least go down to the midpoint of those higher time frame fair value gaps, but it's not necessary in all situations. And plus, I got a great R multiple right here, especially once I was able to reduce that stop loss, right? The trade ends up becoming about 4R. So that's the way I do it. I think it's a safer place to put your TP right at the beginning because if we were very bullish, it could just wick into it by a couple ticks and then blast off. That's always possible. But that is the trade that we took today. And again, I really just wanted to do my best to highlight how I marry ICT concepts with volume profile. The volume profile can give me a directional bias in the sense that if we're below previous day's point of control, I'm looking for shorts. Above previous day's point of control, I'm looking for longs. But on top of that, it can give me great levels to play trades off of and great invalidation areas, right? My invalidation area wasn't just that it was above this structure. It was that that structure was also just below the previous day's point of control. So there's multiple confluences stacking up for why my stop would be here instead of here or something. You know what I mean? So that's the trade, guys. I'm going to keep making more videos to focus on how I use both of these concepts together because I really think it is my edge using volume profile and ICT in conjunction. I really think I'm one of the only traders doing it right now, especially at least when it comes to people making videos on YouTube. So I'm going to keep doing that, keep putting out that value for free. I hope you guys learned something. If you have any questions, shoot them in the comments. I'll be on ASFX TV Tuesdays, Wednesdays, and Thursdays, 11 a.m., where I stream live. And we take these setups live every day. Again, that's 11 a.m. Eastern Standard Time. And one last thing, Top One Futures, we are still launching our promo for 40% off. You could use code ZARB. You can get that discount no daily loss limit, and anytime payouts. Really great value. See you guys there. But yeah, have a good one, guys. Peace.